To this day, the greatest investor of all time, Warren Buffett, believes that the greatest investing book of all time is this one, Ben Graham's The Intelligent Investor, first published right back in 1949. Today, more than 70 years after the book was first published, the core lessons in The Intelligent Investor about making good returns without taking undue risk remain as relevant as ever. And the book to this day is still one of the best-selling finance books on the planet. In this video, the first in a three-part series covering value investing fundamentals here on the channel, I want to go through the first lesson that I picked up from Ben Graham's The Intelligent Investor that has truly stood the test of time. So if you enjoy the video and haven't subscribed to the channel already, please be sure to do so. But without further ado, let's get straight into the video. Now, Graham begins the book, The Intelligent Investor, with a topic that will be sort of the core focus of this particular video. And that, quite simply, is answering the question of what investing actually is. Because Ben Graham has quite a different view to what traditional people might view as investing. He doesn't view, for example, just buying a random group of stocks and bonds or a random bit of real estate that you think might be worth more in the future. He doesn't view that as investing. He instead has quite a clear definition on what investing actually is. So let's first take a look at what Ben Graham's definition of investment is, and then I want to share three examples of what I would view as investments by Ben Graham's definition, and three examples of speculations or things that don't fit Ben Graham's traditional definition. So Graham states quite clearly, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. And you'll notice here that Ben Graham is careful not to restrict himself to any given asset class. You'll notice he doesn't say that stocks are speculative and bonds are investments, and he doesn't kind of pick out any individual industries. Rather, it's the characteristic of each individual opportunity on its merits that really defines whether that particular opportunity is an investment or a speculation. And like I say, to kind of make that hopefully a little bit clearer in your minds, I want to share three examples that both fit and then three more that don't fit Ben Graham's definition. And the first one I want to talk through that certainly does fit the definition of investment from Ben Graham is actually a former Ben Graham investment, and that is in Rockwood & Co. Now, the Rockwood & Co. story is actually quite an interesting one in its own right. I've done a full video on it here on the channel. I will leave that linked up in one of the corners here if you're interested in checking that out. But long story short, with Rockwood & Co., they were essentially a chocolate company that was going through quite an unusual situation where shareholders were able to exchange their shares for a given amount of cocoa beans. There had been a recent boom in the price of cocoa beans, and this whole thing was sort of kicked off by particular investors in the company being quite active and kind of pushing management to go through this process. But long story less long, Rockwood had a market price in the stock market of about $34 per share. And what Ben Graham and his associates were basically doing, actually Warren Buffett included at that time, were they were going out and buying shares of Rockwood, the chocolate company, for $34 in the stock market. They could then take their shares and convert those to cocoa beans, which at the time were worth about $36. So it's a slightly abstract, unusual example of an investment that Ben Graham made throughout his career, but it did tick the two boxes. It offered safety of principal because all Ben Graham had to do was lay out $34. He would be given $36 worth of cocoa beans, which he could immediately turn around and sell. So there was really no massive risk of losing his initial $34 investment. So he definitely ticked the safety of principal box. And he also captured a small gain of about 6%, the spread between $36 and $34. So it happened in a very short space of time. You could buy the shares and turn around and sell the cocoa beans pretty quickly, probably within a day or two. So although the gain was quite modest, only 6%, given the time that it was happening in, it was certainly an adequate return as well. Now, the next story that I would definitely classify as an investment is one shared by Warren Buffett in his 2013 letter to shareholders. He told the story of a bubble in the farming industry bursting in Nebraska back in the 1980s. And it gave Warren Buffett the opportunity to basically buy a cropping farm that was producing corn and soybeans much cheaper than he would have been able to a couple of years earlier when the prices were really in bubble territory for those farms. Buffett, really not the farming type, actually consulted his son on the farm purchase, who was very much the farming type, and his son was able to give him some good information on what Buffett could probably expect in terms of yields per acre for his corn and soybeans, how much it costs generally to operate a farm each year, and Buffett was able to do some basic calculations on how much money he could earn off the farm each year in a typical year versus the price he had to pay to buy the farm. So Buffett ended up paying $280,000 to purchase the farm, and he felt that in a normal year he could probably expect to earn about a 10% return, or about $28,000 on his initial investment. And he also went into this farm ownership with the idea that productivity would probably go up over time as technology got better and farming techniques improved. And he also thought that corn and soybean prices would probably recover from the somewhat depressed levels they were at the time. And it turned out that Buffett was right on both fronts. So if we fast forward 28 years to when he eventually shared this story with Berkshire Hathaway shareholders, the farm had appreciated about 5 times in value, and the annual earnings from the farm had gone up about 3 times from when he first purchased the property. So does this tick the 2 boxes to be classed as an investment by Ben Graham's definition in The Intelligent Investor? I think it certainly does. In terms of, firstly, safety of principal, Warren Buffett went through and did some calculations on what he expected he could likely earn from the farm each and every year. He was able to tie the price he was paying for the farm back to, some fundamental earnings and cash that the farm was producing each and every year. Buffett, being taught by Ben Graham how to invest in the first place, likely approached that calculation very conservatively. He was probably conservative with the soybean and corn prices that he was using in these calculations, and therefore it definitely would have offered safety of principal. It's very unlikely that in a normal market for farms that someone would only pay 10 times the annual earnings of a farm to purchase the property outright from Buffett, should he choose to sell it at some point in the future. And in terms of an adequate return, Buffett was able to earn, a double-digit cash return right out of the gate from this farm, and it grew nicely over time for him as well. And the third one in terms of an investment is Apple. Let's look at Warren Buffett's probably best ever investment, certainly his greatest in terms of total dollars made, from about a $30 billion initial investment. His Apple shares are now worth more than $170 billion. And I would say that Apple most certainly could be classed as an investment based on, a similar process that we talked through with the farm. Warren Buffett was able to look at the price that Apple was trading at in the stock market relative to its current earnings and cash flows and what he expected it might earn in the future, and he saw a very reasonable price. Apple was trading at anywhere from about 10 to 15 times its annual earnings over the period in which Buffett acquired his stake in the business, which, if we invert that, say 10 times earnings, to put it in a earnings yield term, just like our farm, again, that would be about a 10% return. But importantly, at the time Buffett made his initial investment, Apple also had this huge pile of cash around, and the management of the company had been quite clear in saying that they wanted to return a huge chunk of that cash to shareholders over the next few years in the form of dividends and predominantly share buybacks. And if you accounted for all the cash that Apple had laying around at the time Buffett made his investment, the earnings yield looked much more attractive, potentially even as high as 20% or very close to it. So did it have safety of principal? I think yes. Apple had basically no debt and they had an enormous amount of cash around. Buffett was of the view that he's shared in interviews over the years that the screen on the iPhone, for example, is some of the most valuable real estate in the world. So in terms of safety of principal, yes, I think it definitely ticks that box. And in terms of an adequate return, well, a double-digit return plus that's likely to grow over the years, I think certainly ticks that box as well. Now, the interesting thing with all of those examples of investments is I think as we went through all three of them there, we increasingly probably had to predict more and more about what's likely to happen in the future. With the Rockwood cocoa example, there was basically no predicting the future required. You could take cocoa beans, sell them immediately at the market price and capture a small spread. With the farm example, Buffett had to make some conservative assumptions about how much he thought corn and soybeans might sell for at some point in the future, which, there is a degree of guesswork about that, but you can be conservative in your assessment of that particular farm. And with Apple, Buffett had to have some confidence that consumers would continue to buy Apple products year after year after year. But overall, after the thorough analysis that Ben Graham describes in The Intelligent Investor, I think each of those three scenarios definitely ticked both boxes to be classified as investment. So what then would Graham classify as speculation? Well, I want to give three examples of what I think are quite clear speculations. Now, there's a lot of grey areas, I must say, between investing and speculation. Some things are very clearly investments, like the three we just spoke about. Some are very clearly speculations, like the three we're about to talk about. But some are probably somewhere in the middle. And with many potential investment opportunities, there's always going to be some degree of speculation built in. And that's where your own analysis is really going to come into the picture when you're looking at potential stock investments or investments in other fields. And I should also say that there's nothing like morally wrong about speculating in markets. You can certainly make money doing it. You can certainly also lose money doing it. They simply don't meet the basic criteria of a value investment in the eyes of Ben Graham and Warren Buffett. So the first kind of classic example that Ben Graham would likely class as a speculation would be something like a precious metal like gold or silver. Now, gold, of course, does have real-world uses in jewelry, for example. It's increasingly getting more and more difficult to find over time, and it's got a long history of being used as sort of an alternative currency, through the millennia as well. But the important distinction here is that gold is not a productive asset. It does not produce annual cash flows that the investor can sort of tie a valuation for gold back to like you could for a farm or for a business. Again, that's not to say there's anything morally wrong with going out and putting money into gold. It's simply not an investment. It's really a speculation because you can't link it back to its underlying fundamentals and its underlying ability to produce cash flow. And to a large extent, you're really exposed to just what the next person is willing to pay for your gold if you're wanting to buy some and hope to make a profit on it. Next up would be something like highly speculative, negative cash flow real estate. I actually saw quite a good example of that posted on Twitter just this morning. And sort of the bullet point highlights are basically this. The particular person in question was basically not wanting to invest any more money in the stock market. They kind of felt that was too risky for their particular circumstance for whatever reason. But they were interested in buying a rental property that was a little ways out of town. And the kind of key message here with this rental property is that the rent probably or almost certainly wouldn't be enough to cover the current mortgage payments. It would be a negative cash flow situation. But they were, quote, banking on the property going up in value over time and getting a return that way. Now, again, there's nothing morally wrong with this type of strategy, and in some cases it can and has worked very well. But in terms of it being an investment and meeting our two quite simple criteria of safety of principal and an adequate return, it just doesn't quite fit the bill. In terms of safety of principal, you don't have enough cash flow to cover even your mortgage payments, so it really doesn't offer that key component. And if the price you're having to pay to get the property in the first place doesn't cover just the mortgage payments, it's likely quite an expensive property as well, of course, relative to the rent that it's throwing off. And in terms of the adequate return piece, we really just don't know. It seems to be the type of property that it's really just whatever the next person is willing to pay. It clearly doesn't seem to be tied to the fundamentals of how much cash that building produces as a rental property. And the third and final example that I want to give of something that would certainly be classed as a speculation is basically anything that just falls into the general category of the next big thing. And this might include, fast growth, high tech, quite unprofitable type businesses that were really all the rage in 2020 and 2021. These are the types of potential opportunities that can be really, really exciting for people. Of course, everyone wants to find the next Apple or Amazon or Tesla or that sort of thing. And when you look back at some success stories like that and say, wow, if I had, invested in that company 10 or 15 years ago, I would have done extremely well. That's really compelling for a lot of people. The unfortunate thing is that there's a lot of survivorship bias in that very small sample group, and it really doesn't show the high percentage of these very speculative investments that go wrong and cause people to lose money. It's estimated that 50% of venture capital backed startups have failed within 5 years of getting that funding, and it just simply doesn't pass the first test of safety of principle from Ben Graham. So to wrap up this first value investing fundamentals video, I think we've got to keep that quite clear definition of what an investment is really front of mind, and it requires two very simple things. It requires, after thorough analysis, an adequate return and safety of principle. Everything beyond that doesn't meet those two simple checkpoints is speculation, and there's nothing morally wrong about speculating in markets. You can do very well, but it often comes with a much higher degree of risk. There can be a lot of grey area between an investment and a speculation as well. Something that is an investment for me, but is in an industry that you don't understand, for example, may well be a speculation for you, and vice versa. And one of the things I find really interesting about this definition from Ben Graham is that he really doesn't restrict himself to any given asset class. These exact same principles can apply across stocks, bonds, real estate, or even the laundromat down the street. So thank you very much for watching the video. Please let me know your thoughts down in the comments below on your views versus investing versus speculating and what may or may not fall into each of those two categories. If you enjoyed the video and haven't subscribed to the channel already, please be sure to do so, and keep an eye out for parts 2 and 3 in this value investing fundamentals series as well, including the final video in the series where we'll go through a detailed method for calculating the intrinsic value of a company. But that's it from me for this one, and I'll see you on the next video. Cheers.